Greetings, ladies and gentlemen. My name is Webster Skauge, and I would like to welcome you to lecture number 1. But before you watch this lecture, I urge you first to watch the introductory lecture if you haven't watched that one. But if you have already, then welcome to the Conceptual Framework. So the Conceptual Framework is basically the first lecture that we have in financial reporting because this sets the foundation of accounting and reporting. Now, let me start by explaining the purpose of the conceptual framework. So the conceptual framework is basically it's a number of concepts which have been gathered together by the board, which allow the board to have a basis to make any decisions to the setting of standards. So basically, the purpose of the conceptual framework is to assist the board in the development of IFRS by using those basic concepts and principles, which gives them a guideline to say when they want to introduce a new standard, for example, it has to be aligned to those basic concepts and principles. It also assists the preparers of financial reports to also develop a consistent accounting policy for transactions because they understand the underlying concept in terms of how to develop a concept, how to develop a principle. So when they develop a policy, it has to align to the basic principles. And also it assists all parties to understand and interpret the standard when they go back to basics. So in a nutshell, we can say the conceptual framework is rather a framework that can be used for accounting. Remember, a framework guides you so that you don't overlap, you don't go across the boundaries. So these are basic concepts and principles which are kind of like guidelines and boundaries to which you can use to make a decision. It can be used by the board, it can be used by preparers, it can be used by users. Everyone can use the conceptual framework. Now, it is important for students to understand that the conceptual framework is not a standard. Like I said, it is a guideline. It is just basic principles which guide how to develop the standards. Once a standard has been developed, the standard overrides the conceptual framework. So where we've got an accounting treatment that we require, we always go to the standard first. The standard is the one which gives the principles. If the standard is not giving you a guideline, then you can go back to the conceptual framework just to figure out how can I make a decision within certain boundaries. But otherwise, the standard always comes first. Now, the conceptual framework has got 8 chapters. This conceptual framework that I'm talking about, the one which will be examined on, is the conceptual framework which was issued out on 18 March 2018. So there's another one that we used to use which was issued out in 2010. That one is now outdated. The ISB is actually amended the conceptual framework of 2010, so we're now using the 2018. That is the one that will be examined on. So it has got 8 chapters, and these 8 chapters cover various aspects, with chapter 1 focusing on the objective of why we prepare financial statements. It explains why financial statements are important to be prepared. Then chapter 2 explains the qualitative characteristics of useful financial statements. So for financial statements to be useful, there are certain qualitative characteristics which are expected, and chapter 2 outlines that. Then chapter 3 focuses on financial statements that can be produced by an entity, as well as what is a reporting entity. So it explains that, and it outlines the number of statements which are expected to be prepared. Then chapter 4 brings out definitions of the elements of financial statements. So for financial statements to be prepared, you need to include assets, liabilities, income, expenditure, and equity. So it explains what those elements are. What is an asset? What is a liability? So if you want definitions for those, you go to chapter 4. Chapter 5 explains the recognition and derecognition. So what is expected for someone to actually recognize something in the financial statements, a transaction in the financial statements, and what is expected for someone to derecognize it from the financial statements, from a guideline point of view of the conceptual framework. Then chapter 6 outlines the measurement basis. So when you're preparing your financial statements, what basis do you use to come out with a figure, to come up with a certain figure that you then put in the financial statements? That gives the guidelines in terms of the measurement basis which are allowable from the ISB. Then chapter 7 explains how do you present that information that you want to give to your users, how do you package it, and if there's any additional information that you need to support your figures, how do you disclose that additional information. Whilst chapter 8 looks at the concepts of capital and capital maintenance, we do not cover chapter 8, but we cover chapter 1 to 7. So this is the scope, ladies and gentlemen. This is what you expected to understand from the conceptual framework. Now, take note that I expect you to actually go and read the standard, the conceptual framework. You need to actually go and open the actual conceptual framework and follow through and understand where do you get this information, because our examination, like I said in the introductory video, it's an open book. So I don't expect you to be cramming things. I expect you to know where to find those concepts and principles within the handbook. So we'll go from each chapter, from chapter 1 to chapter 7, and explain each particular chapter. Let's start with chapter 1. So chapter 1, like I said before, it outlines the objective of financial reporting. Why do we prepare financial statements? Why do we report? So the main objective is outlined by the conceptual framework. Says we provide financial information to the users for them to be able to make certain decisions which are related to the providing resources to a particular entity. So when we look at the objectives seem to be centered across those people who make decisions in terms of providing resources to the entity. Now, if you try to think of who provides resources to a certain entity, those are the users of the financial statements. So that means the primary users of financial statements, like what's outlined in the conceptual framework, are the investors, because the investors are the ones who provide resources to the entity. So investors, your shareholders, your potential shareholders, those people are the ones that we prepare financial statements for. But we also have people who provide resources in the form of debt. So our lenders, our banks, our financial institutions, the people who give us credit are also the part of our primary users, because they provide us with financial resources. Then we also have got creditors, because as an entity, as we function, sometimes we buy our inventory on credit. Sometimes we are provided services on credit. So that means we are also being provided resources. So when you look at the users of our financial statements, we mainly focus on those people who provide resources only to the entity. Those are not the only users. We also have got other users. For example, you can have your employees, you can have your internal staff, you can also have the government and stuff like that. But those are not the people that we prepare financial statements for. We don't prepare financial statements specifically for the government or specifically for our employees, but rather for these people who provide us with resources. So that means each time we're preparing our financial statements, we need to consider what information do these users need so that we achieve the objective of preparing those reports. So remember, our users are very much interested in that information, and they want to know if they provided resources to you. They want to know how is what is management stewardship position and effectiveness. How effective are the managers of the entity in utilizing those resources to create value? Okay, so there are a number of decisions which will be made, which include how well do you perform, what is the financial status at the moment, how did your cash move, and stuff like that. Okay. Then chapter 2, ladies and gentlemen, focuses now on, if we've agreed that we want to produce financial statements to the people who give us resources, then what information do they need for us to say they can make a decision? That information, for it to be useful, it needs to have certain qualitative characteristics. So chapter 2 then outlines and says, if your financial statements do not have 1, 2, 3, then the people who give you resources are not going to be able to use those financial statements, so they're not useful. So there are two fundamental qualitative characteristics that should always be achieved each time you prepare your financial statements. And the first one is relevance. So your financial statements should be relevant at the end of the day. That is what we're trying to achieve. Because if they're not relevant, then no one's going to use them. So when you talk about relevance, we're talking about the user wants to predict what can potentially happen in future. So your financial statements should have predictive value. Your financial statements should be able to confirm stuff which has happened in the past. So they should have confirmatory value. The moment we have got these two, then we can say your financial statements can actually be used by someone. So they are relevant. So they are supposed to contain information which someone needs to use. Now, when we look at relevance, we focus mainly on, is the information that you are producing capable of making a difference in terms of decision making? So without that information, would an investor or a creditor or a lender have changed their mind before seeing the information and after seeing the information? If that happens, then we say, yes, your financial statements contributed to the decision-making process, therefore they were relevant. So relevance is a fundamental characteristic. The second fundamental characteristic is faithful representation. So your financial statements should faithfully represent the economic phenomena of what has been happening, or what we call the substance. So for this to happen, we're saying there are three things that we look at for us to say you have achieved faithful representation. Number one, your information should be complete. You should not have missed some of the information, especially intentionally. Your financial statements should be complete. We expect them to contain all the information which is relevant for someone to make a decision. Otherwise, if you do not include some other information, then we can no longer be able to make an informed decision because you've withheld information. So completeness is one of them. Then neutral. Your financial statements should be neutral. It should not take any position. It should not take position either for your benefit or for the benefit of the government or for the benefit of anyone. You should just be an open book, be neutral, and present things as they are, which is why we emphasize a lot on let's look at the substance of the transaction rather than legal. Because sometimes legal is looking from a political perspective or from a government perspective, which then undermines neutrality. Then the most important one is your financial statements should be free from error. If they've got errors, then how am I going to make a decision based on information which is full of errors? So financial information should always not contain errors. The moment you manage to achieve these three, then it's likely that you have achieved faithful representation. Okay, then someone can actually make a decision out of your financial statement. So when we look at these two, relevance and faithful representation, we say these are the fundamental qualitative characteristics of financial statements. If these are not there, then your financial statements are not useful. We also have other qualitative characteristics which are not fundamental but which are simply enhancing the value of your financial statements. So they enhance the usefulness of your financial statements. Okay, so if these are not there, it doesn't necessarily mean that your financial statements are not useful, because your fundamentals are the most important. But please note that if your fundamentals are not there, your enhancing do not come and make unuseful financial statements useful. So these are simply adding already to financial statements which we say are already useful because they're meeting the fundamental ones. So these are simply enhancing. So we look at comparability. A user should be able to pick a trend and see how have you been performing in the past and how has been the trend growing over the years. They should also be able to compare your performance with other similar entities within the same industry that you are operating in. Then your financial statements should be verifiable. So when I get your financial statements, I should be able to take a third party, which is an auditor, and say, look at these financial statements. Can I rely on them? And the person comes and says, yes, you can actually rely on them. So whatever transactions which you're putting out there, they should be verifiable, which is why I've got audit. Then financial information should be presented timely, because if you do not provide the information timely and you produce financial statements today, which are for 2 years back, then maybe the decision was supposed to be taken 2 years back, not today. So the earlier you provide information, the more it becomes relevant. The more you delay providing that financial information, the more your information also becomes irrelevant to the users. Then understandability. You are not preparing the financial statements for yourself. You are preparing those financial statements for someone else, the user, which is the lenders, the investors, and the creditors, being your primary users. They should be able to interpret and understand that information for them to be able to make a decision. So the moment they do not interpret and understand that information, then your financial statements becomes irrelevant to that person because they cannot influence the decision making, which is why we emphasize a lot on trying to make your financial statements as simple as possible. The major information should be out there, okay, which is why we emphasize on disclosure to provide more explanatory information, which is also why we focus on do not standardize the way that you prepare financial statements. The financial statements should be specific to the entity. So we do not encourage boilerplate disclosures because they do not talk to the entity. The moment you give information which is specific to the entity, then a user will be able to understand you and will be able to make a decision concerning you as an entity. So these are the enhancing qualitative characteristics. Now, there are certain underlying assumptions which are there in the preparation of financial statements. And the major one is there is always an underlying assumption that your entity is a going concern. And I've put this guy who's going. So going concern simply means that when you're preparing financial statements, you're preparing them in an assumption that the entity is going to continue its operations into the foreseeable future. So that means we can use historical cost basis as a measurement model because we're expecting you to continue operating. But the moment you no longer become a going concern, then the creditors are worried that they need their money back. The lenders are worried they need their money back. The investors are worried, are they going to be able to recover their investments? So the moment you're no longer a going concern, it shifts a lot of things. It changes the dimension in which you report, and it changes the measurement model in which that will be using for financial reporting. Yeah. So going concern is an underlying assumption which is always made. Auditors always assess this going concern to see if it is there, because if it's not there, it changes the picture of reporting. Chapter 3. So Chapter 3 focuses on the financial statements, which one is expected to prepare and who is expected to prepare them. So financial statements are basically those financial reports that we're talking about, which you need to give out there. The reports focus on the 5 elements, which are you're reporting on your assets, you're reporting on your liabilities, you're reporting on your equity, you're reporting on your income, and you're reporting on your expenses. But then you break down into various statements, which we'll talk about just later on. Then the reporting entity is an entity that is required or chooses to prepare financial statements. So the moment you say I'm preparing financial statement, then you become a reporting entity. Then Chapter 4 focuses on those elements now. So we talked about in Chapter 3, it says you are supposed to prepare financial statements, which may be group financial statements. They may be individual financial statements. The group one is the one that you consolidate the controlling entity with all the entities which it controls. Whilst the separate ones are the ones where an entity is reporting without considering the relationships that it has with any other entities. Okay. We also have got combined entities. Combined entities are simply when you take a number of financial statements of entities which do not have a direct relationship between themselves. Okay. So chapter 4 explains those elements which we said are supposed to be contained in the financial statement, which are your assets, your liabilities, your expenses, your income, and your equity. So they're explained in chapter 4 for you to know what they are. So it starts by explaining what an asset is and says an asset is a present economic resource controlled by the entity as a result of a past event. This definition has changed. Previously, we used to have a definition in the 2010 Conceptual Framework which said an asset is a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow to the entity. Now, scratch that definition. That one is no longer applicable. We are now using this new definition. This is the definition which you'll be expected to apply, and that's the one that will be examinable. So the keywords for an asset, for you to say you hold an asset, is number one, is your asset a present economic resource? And the conceptual framework explains what a present economic resource is and says an economic resource is a right. So you need to look at, do you have rights related to this resource that you have? So an economic resource is a right that has the potential to produce economic benefits. So is there potential that you can actually produce economic benefits? The moment you have got this, then you can say, I've got a present economic resource. Once you've got an economic resource, the next question is, do you control that economic resource? Controlling an economic resource means you can utilize it when you feel like. You can use it in the manner that you feel like. You can change the way that you use it. You can determine how it makes money for you, how it makes future economic benefits for you. So do you control that economic resource? Then, thirdly, the next keyword is it should be as a result of a past event. The moment you've got all these three key words ticked, then you can say you actually hold an asset. Let's use a demonstration. So I've put this example here which says Harare City Council is an advertisement stand or billboard along the Harare-Bulawayo Road at Showgrounds that it rents out to entities for 5,000 per month. On 1 January 2019, Pure Limited entered into a contract with the council to use the stand for 12 months or to use the billboard for 12 months. Now remember what we talked about in the introductory video. Understand this scenario, what is going on. So we've got a city council which owns a billboard. They rent that billboard, which means they make money out of that billboard. 5,000 per month multiplied by 12 months, which is 60,000 in a whole year if they do get customers for all the months. Then we've got a guy who has taken a 12-month contract, which is Pure Limited. That's understanding of the scenario. Now the required comes and says, using the conceptual framework, discuss the accounting recognition implications of the contract for each party involved. Discuss the accounting. Let's not focus on recognition as yet. Let's simply say, let's discuss the classification of this contract in each party's books, which means how does Harare City classify this contract? How does Pure Limited classify this contract? That's the question that is at hand. So remember, we talked in introductory class that take your knowledge and apply it to the situation. So when I look at this, I'm going to start by, if it's Harare City, what is this likely to be? Is it an asset? We have the definition of an asset, remember. So if I applied the definition of an asset, it said it is a present economic resource. Now, we talked about what is an economic resource, and we said an economic resource is a right that you have. So do you think Harare City Council has got that right, which will produce which has got a potential to produce future economic benefits? I think so, because I think Harare City has got a right to this billboard. They own it. I'm now applying myself. So Harare City owns the billboard, which means they've got rights as to who they rent it to and who they don't rent it to. So they've got a right to that produces a future economic benefit. Why do we say it has got a potential to produce future economic benefits? Because Harare City is capable of renting it monthly at a cost of 5,000 to someone else, so they can make money out of the billboard. Great. So now I understand that we have got a present economic resource. Does Harare City control this? Yes. Harare City is the one which chooses who they give the contract to and whether they want even to rent it out. So they are in control of the economic resource. Great. Is it as a result of a past event? Yes, Harare City is the one which either bought this this billboard, or they are the ones who constructed it. So that means this billboard came as a result of a past event, which was either purchase or construction. Therefore, we tick all the requirements for an asset. Therefore, I can say Harare City should classify this billboard as an asset in their financial statements by using the conceptual framework. Tick. How about pure limited? We'll go back to pure limited and say, let's apply the definition of an asset. Do you think pure limited should account for their contract to be using this billboard for 12 months as an asset? So I'll start. Does pure limited have an economic resource? So a present economic resource. So I'll apply myself again. Does pure limited have a right? Yes, I think pure limited has got a right. The right is to use this billboard for 12 months. So they've got a right. Does the right give potential economic benefits to pure limited? I think so. They are advertising here. So since they are advertising, then through advertisement, there's a potential that they will have more customers coming through to buy their products. So the use of the billboard has got a potential of creating a future economic benefit to pure limited. Tick. So pure limited has got a present economic resource. Do they control it? Now that is important. So who controls the billboard? Harare City Council or pure limited? During the rental period, during the 12 months of their contract, I would like to believe that Pure Drop will have control over what is going to be displayed on this billboard. They have got the right to put their name there, to put their products there, and they've got the right to limit what goes there. They've got the right to say no any other party can actually advertise themselves on this billboard. I'd like to believe they've got control over the use of the billboard for 12 months. So that means now they've got a present economic resource which they control for 12 months. Is it as a past event, as a result of a past event? I'd like to believe so. I believe the ability of Pure Limited to actually advertise on this billboard came through as a result of the contract which they signed with Harare City. So the past event is the signing of the contract with Harare City, which gave them the ability to use the billboard for 12 months. So great. I could actually also prove that the other party, which is Pure Limited, should also account for this billboard as an asset, which means to both entities, we can actually end up having an asset in Harare City and an asset in Pure Limited relating to one resource. Okay, you have applied yourself. Okay, so we talked about, so that was application of the asset. Then let's talk about liabilities. The conceptual framework defines a liability as the present obligation of the entity to transfer an economic resource as a result of a past event. And it says a present obligation is an obligation is a duty or responsibility that the entity has, and it has got no practical ability to avoid that payment. That is a liability. So when you talk about liabilities, we're talking about, do you owe someone? Do you have a duty or responsibility to pay someone, and you got no practical ability to avoid payment of that amount? So you're transferring an economic resource to someone, and it's as a result of a past event. Again, let's put this into an example. So we've got Ice Cream Limited here is example number 2. It says Ice Cream Limited is a fast food restaurant that sells ice cream. On 10 January 2019, it was sued by a customer for food poisoning after a customer vomited blood after eating ice cream served from one of its ice cream outlets. Okay, so on 10 January, these guys got sued. The matter was taken to court, and on 14 January 2019, the court ruled that the ice cream did cause the vomiting. Ice Cream Limited was therefore fined $30,000 in court for pain and suffering and for medical expenses incurred by the customer. So understand this scenario. Remember, we talked about this. After understanding this scenario, what is expected of you? So the court comes and says, using the conceptual framework, discuss any accounting recognition implications. Again, for this one, let's remove the recognition. Let's just say discuss the classification of this transaction on 10 January and on 14 January respectively of 2019. So on 10 January, do you think this transaction needs to be classified in a certain manner, and on 14 January, do you think it needs to be classified in a certain manner using the conceptual framework? So in this case, we've got 5 elements: asset, liability, expenses, income, and equity. Choose the most appropriate that you think is the one that you want to apply. It doesn't make sense for you to go and apply the definition of equity when you can clearly see that there's got nothing to do with equity here, or to try and bring a definition of an asset when you can purely see that there's no relation to assets here. But when I see this, I see an obligation, the ice cream having an obligation to pay this customer an amount of $30,000 for pain and suffering, which means they kind of have and the liability as such. So I want to test for a liability. So I'm going to put down my definition. For Ice Cream Limited to recognize a liability, what should be there? There should be a present obligation. And a present obligation, remember we said a present obligation is you're obliged to pay the other party, and you do not have you do not have any alternative not to make that payment. So when we look at 10 January, on 10 January 2019, this guy got sued. When you get sued, does it mean now you've got a present obligation to deliver cash or an economic resource to the other party, to the customer, just because they've sued you? Do you have a present obligation? Are you able to get away with it? Do you have an alternative not to make a payment? We call that the walk-away test. So are you able to walk away without paying at the point of being sued? I think, think about it for a second, but I think that you have got an alternative to walk away. So if you've got an alternative to walk away, that means you don't have a present obligation. Now, the reason why I say I think you've got an alternative is because let's say you engage a lawyer who can represent you, and the lawyer is so good that the guy represents you, and the amount that you got sued for, the judges and the court say you're not liable. That means you've walked away from the payment. So you didn't have an obligation from the start. Or let's say you got sued, but the customer loses the case in court. So that means you can walk away. When you go to the courts and it is determined that you actually do not owe anything, you can actually walk away from this. Okay, so the walk-away test is telling us that this is not yet a present obligation because there's an alternative not to make a payment. But on 14 January, the court then ruled that you need to make a payment of $30,000. On that particular date, Are you able to walk away? Do you have an alternative not to make the payment? I don't think so. The court has made a ruling. So you need to pay the money. Even if the customer dies, you need to pay that money to the customer's estate or to the customer's relatives. So at that point on 14 January, we've reached a point of no return where we are liable. We've got an obligation to deliver an economic resource. What is the past event in this case? The past event is the selling of an ice cream, which is the one which created all of this havoc. Okay, so that's what we talk about when you say apply yourself. Then we got definitions of equity, income, and expenses, which are also given by the Conceptual Framework. For the purposes of the examination, we do not usually use the definition of an expense. We rather prove an asset or disapprove an asset to prove an expense, because there are only two things which go on the debit side. If it's either it's an asset or it's an expense. So if you use the definition of an asset and it fails to be an asset, then automatically becomes an expense, because those are the only two things which go to the debit. Income, we also do not use the definition of income because there's a specific definition which has been given for income in the form of revenue, which is in IFRS 15. So if your income is revenue in nature, we go specifically to IFRS 15 and we use the definition of IFRS 15 there. Because remember, IFRS 15 is a standard, so the standard overrules anything which is in the conceptual framework, like we mentioned before. Then the definition of equity, this one we do use, but this one we use it when we get to IS 32, which simply gives the same definition as well on paragraph 11 of IS 32. So that's that one we do use it. Chapter 5, ladies and gentlemen, talks about the recognition and derecognition. So for you to recognize, the element should have satisfied the definition of any of the elements in the conceptual framework. So you cannot recognize anything which does not fit the definition of either an asset, liability, income, expense, or equity. So if it's not part of those, then it cannot be recognized in the box. But the specific recognition criteria to then say if it's an asset, when do you put it into the box? That one we use the recognition criteria which is given in the specific standards of the various assets and liabilities of the elements. So for example, you can have an asset, but the assets are further broken down into various standards. We've got an asset standard for inventory, which is IS2. We've got an asset standard for PPE, which is IS16. We've got an asset standard for investment properties, which is IS40. We've got an asset standard for intangible assets, which is IS38. Each of those standards has got a different recognition criteria, which it specifies. So the conceptual framework does not give a recognition criteria, but it leaves the standard to then give the most appropriate for that particular element that you would be dealing with. Okay. Then derecognition, okay, for this one, same applies again. You derecognize when the recognition criteria is not being met anymore. Chapter 6. So Chapter 6 covers the measurement basis that we use for reporting. There are two measurement bases which are governed by the conceptual framework. So when you're preparing your financial statements, it's either your financial statements are in historical cost measurement basis, which means the cost that was incurred on the day that the asset got into the books, the one that it carries, and then subsequently it's adjusted. Okay, but with the basis being the historical value. So this is the first measurement basis which the conceptual framework governs. Then there are also, and there's also another option, which is you can actually use current value measurement basis. Current value measurement basis is there are three current value measurement bases that we have, which are these ones that we are looking at over here. Okay, so current value can be fair value. Fair value is covered under IFRS 13. So for this one, we will cover it sometime. If you are in the full class, full-time class, we cover this. If you're in the level 2, we cover this. But if you're in level 1, you do not cover this in level 1. We only cover it when you get to level 2. So fair value is one model which represents current value. Then we've got value in use. So fair value is basically the value that you incur to transfer or settle a liability, or you get to or you get to obtain an asset. But the IFRS 13 covers this in detail. Then value in use, this applies to mainly our assets that we have. For the assets, for us to use them, what value are they going to potentially give us in future? So it's a discount of future value. Again, that is our value in use. So this is also another acceptable method. You will see that IAS 36 focuses a lot on value in use. It's one of the standards which actually uses this measurement model. Then we also have got current cost model, which is basically at what cost will you be able to replace a certain asset today? That's current cost model. So these are the measurement models which are acceptable from a conceptual framework point of view. Chapter 7, ladies and gentlemen, talks about presentation and disclosure. How do you present that information now? How do you package that information to give it to the users of the financial statements? And it's important, ladies and gentlemen, to take note that if you do not package your information well, it becomes not easy for the users to pick the most relevant information or to understand your information. So the packaging is very important, and the conceptual framework kind of gives a guideline in terms of how to package that information for it to still be useful to the financial the users of the financial statements. And I think I mentioned it before earlier on in this video that when you're reporting, when you're packaging your information, it's best not to give standard descriptions, descriptions which are just universal, which are just general. But sometimes what we need to do is, in fact, most of the times what we need to do is give entity-specific information rather than standardized information, standardized description. Talk about your own self. Talk about your entity-specific information. So when you go standard description, general description, we call that boilerplate accounting, because you're simply giving us what the standard says. So an asset is that. What is your own asset is what we're very much interested in. Then try not to duplicate information in different parts of your report. If you've already said something, then that's fine. It does not make sense to have a report which is 10 pages, but those 10 pages are duplication. I would prefer to have a 2-page report which has got information which is relevant, which is not duplicated, and doesn't frustrate when you're reading it. Then in terms of packaging, we talked about it. Your financial reports, they fit into different number of statements, which each one serves a different purpose. So these are the 5 reports which are expected to be produced when you produce financial reports. Okay, I believe from your undergrad you already know these financial statements. Okay, so ladies and gentlemen, that is the conceptual framework for you, which is simply setting us to now start our accounting in the various standards. So the next thing from this video is we're now getting into video lecture number 2. Video lecture number 2 jumps straight now into the standards. So we can start with IAS 1 and moving up based on, if you look at your lecture program, you actually see that. Okay, but we'll start by attacking assets first. We finish off accounting for all the assets. We jump from there and we take the next level. But at the end of the day, when we finish CTA, we should have covered all the 5 elements. So you would be expected to use the standard to account for all the assets, account for all the liabilities, account for equity, account for income, and accounting for all the expenses. That is our mission and our objective, and to present that information and disclose it in a proper way that makes the use of the financial statements make decisions out of those reports. Okay, I hope this video lecture was helpful for you and you've enjoyed it. At the moment, I've not yet posted any questions related to the conceptual framework to practice on, but over time you will see as we attack the other standards, we'll keep referring to the conceptual framework and we'll practice the conceptual framework that way. Okay, Thank you very much.